Welcome into a brand new episode of WSI TV. Enjoy the show.
Welcome back for another brand new episode of Bishop's Move. I'm your host, Jordan Bishop, and I'm joined by Tayler Klinkbeil. How's it going, Taylor?
Pretty good. How are you, Jordan?
Good, thanks. So before we get into this episode today, as always, make sure you visit WSITV.com, head on over and sign up for the free daily newsletters and get instant access for that WSI Vault. So Taylor, I'm going to hand it over to you. What are we talking about today?
So today we're going to talk about FinTech, which is an abbreviation for financial technology. Basically what we're going to talk about how is the old traders and all of the old institutions that we've heard the big names in the past, they're kind of moving into the 21st century now. And that's a good thing for you as an investor because you can take advantage of the new things that they're implementing into their trading systems, things like trading online and other stuff that we're going to talk about later. But it's really just talking about how the market is kind of moving into a new direction. And as we're getting over the trade war headlines, which I'll go put money in the trade war jar later, but the Brexit headlines, all the things that have kind of been throwing and shaking up the market in the past with the uncertainty we've been seeing. We're in a bull market, as you can see. So we're going to try and move forward into the more positive side of things and see how these changes are going to make a positive impact on your returns.
Great. So what that means, Taylor, right, is that it's more some certain systems are more accessible to the average person, right? Sure. So you're going to be able to access more systems that these big institutions are using without the technology that they're using, right?
For sure.
It's becoming easier, basically. And just a quick anecdote of how technology works in the stock market. You know, you can go back 100 years and certain systems will work the same. But right now, what's happening is trades are going to get quicker. You're going to be able to react quicker. Just a quick anecdote here, just to sort of shine a light on that, is in the crash of 1929, the ticker tape, the physical ticker tape, was a proponent of what crashed the market because it was moving slower than what everybody could see and everybody panic sold. So we don't have that issue today. Of course, technology comes with its own issues.
Yes.
But with FinTech moving into the market, it really makes it easier for us all to hopefully make profits, you know, as long as you're on the right end of that. And it's revolutionizing the way we invest. So Taylor, why don't you jump a little bit more, why don't you dig a little bit more into this FinTech?
Yeah, of course. So like I said, it's the combination of finance and technology, and it's basically just different ways that we're servicing people in their personal finance, also in investing. One of the main goals of FinTech companies now is to try and serve the underbanked, people that don't have access to bank accounts, for example, or people that just don't use them as often, or even just digital payments, and people that aren't as used to the financial world or as used to investing. It's really easy to get involved now because you can just start an app or you can open a website and bam, you're on an investment account. You know, it's not like you had to go down to a brokerage in the past and know what you were talking about. Now they have like really easy resources for people to get involved. So it's really opening up and lowering the barriers for people to start investing.
Right. I mean, what's funny is they used to actually have physical shops you would walk into and go place your trade in there.
Yes.
Now you can do it from your couch.
Exactly.
And you have access to even more trades with that.
Exactly.
So very interesting. But of course, the big banks, they need to keep up with this. They need to keep on top of this technology, right? So what are they doing to keep up, and who are the players that are keeping up with this?
For sure. So one of the most common things that we've seen recently is that, as we said, trading is going online. You're able to do it on your phone, you're able to do it on your computer. You no longer have to go down to the brokerage shops or even the trading shops. And you can do this at your own pace, wherever you'd like to. And so it's really helping to do it online and things like that. It's also allowing you to, some of these new brokerages are doing fractional ownership, which is where you don't have to buy an entire share of something to have a stake in it. So for example, we can say Amazon, this last I checked, the stock price was well over $1,000, which if you want to get into, exactly. So $1,800 for one share is kind of ridiculous. And most people don't have that much money that they would want to put into one company, you know, for example. So fractional ownership is allowing you to own, say, a percentage of an Amazon share.
Right, and what's interesting about that is I wonder what that's gonna do to the volume of Amazon shares.
Exactly.
You know, a lot of the times when companies get that high in price, they'll do a stock split to make it more appetizing for, you know,
other investors.
Investors that are looking for more of a value deal,
Exactly.
right? So if Amazon was $2,000, if it did a 10-to-1 split, there'd be 10 shares for every 1 share out there, but the shares would now be worth $200. So I wonder, I would just watch the market to see if this changes any of that behavior. But again, the trading sort of stays the same. You'd still make the same type of profits.
Exactly.
You just have access to more stocks,
Exactly.
right? And commission-free trading
Yes,
is
this
massive
is a new one
now. So why don't you talk
Yes.
a little bit about that?
Yes, so in the past we've seen like Robinhood is a big proponent of this, where you don't have as many fees. One of the biggest things about like trading ETFs, for example, there are huge fees associated with those trades.
Right.
So most people don't do it, and then you miss out on those profits. But commission-free trading is coming through fintech, is coming into the older institutions now. Charles Schwab announced it recently, as did Fidelity, among others, that they are now reducing the fees and eliminating them entirely, basically on domestic trades, which totally saves you a whole bunch of money in your capital investment, and then you can make more money on the back end.
Right, and what I really love about that is it's taking money out of the banks, and unnecessary cash is flooding their way and putting it back in your pocket. So that's always a good thing for the smaller or the average investor, whatever you want to call it.
Yeah.
So there's a few companies doing this. We've got Fidelity, Charles Schwab are massive, and then we have some on the smaller side. We have Betterment and M1 Finance. I'm not too familiar with Betterment. What is that? What are they all about?
They are very similar to M1 in just that they're more accessible for people that want to start trading. It's definitely a stocks for beginners kind of platform. But we've also seen big companies like Fidelity and Charles Schwab and JP Morgan, which we'll talk about in a moment. They've kind of taken these ideas from Betterment and M1 Finance and Robinhood and kind of ran with them. And like the startups, it seems like these smaller companies that you and I may have heard about, but the average investor hasn't, they're kind of running with their ideas and using them and adapting them for the bigger institutions to allow different people to get involved, I guess.
Right, and I think the big banks need to do that. The ones that sit down and fall by the wayside. I mean, I haven't heard too much about Wells Fargo pushing into the fintech space. I mean, they may be doing things behind the scenes, but of course they're still dealing with the repercussions of rebranding from that scandal a few years ago. So hopefully, for their sake, they have a department that's focusing on that.
You'd hope so, right?
But these big banks need to keep up with this, because you do have, as you said, Robinhood and M1 Finance, which I want to touch on really quickly. M1 Finance is a great way to just have your portfolio pie just simple right there in front of you. Let's say you've got anywhere from, say you've got $1,000, you've got 10 stocks you want to be in, you can say you just want 10% across the board in each stock. And it's that clean. It's not as quick as Robinhood. You can't say, they have trading windows. So in the beginning of the day, they'll buy or sell whatever adjustments you make. So if it's 3 o'clock and a stock tanks, you don't necessarily have the means to hop out of that as quick. It is more of a longer term, like self-serve retirement account. But it is a great tool at the same time. I use it. There are others out there that are very similar to M1. So it's definitely worth checking out. But yeah, these big banks, they need to keep up. So how does this benefit the viewer directly?
So how these changes benefit you is that obviously you benefit from the ways that it affects how you invest, and you spend less on fees. Like we said, you can own parts of shares that you couldn't own before if you didn't want to spend as much money maybe. And you can trade from home and wherever you'd really like to, and it's more convenient, really, just to get involved in investing in general. But you're also going to be on the forefront of the new way that people are going to invest as we come into the future. Obviously, technology is not going anywhere. These fintech companies are explosively huge already, and they're just getting started, So you're getting in on it on the ground floor, literally, if you do get involved now, and you can take advantage of the way that not only they're revolutionizing investing, but we also have some companies that look really good that you could even own a part of that are getting involved in this too, which is going to be good for them in the future and their stock price.
Right, absolutely, and it's about time. I mean, it's been so long where the man in the street can't make their trades. They have to rely on a fund manager. I will say just a small bit of caution here, though. Just because it's easier to do doesn't mean it's always more profitable. I mean, you still have to be careful. You still have to know what you're doing.
For sure.
You look at the Bitcoin bubble. It was so easy to buy Bitcoin back in 2017 that it just got out of hand. And I'm still extremely bullish on Bitcoin long term. But it makes it easier for, you're sitting on your couch, you just make a trade. On a larger scale, that affects the price of the shares. So just be careful. Make sure you're, again, watching all of our videos, reading all our newsletters, keeping ahead of the curve there, because it will get more and more flooded with investors who don't really know what they're doing. So
for sure.
Just a quick word of caution there. But let's get to the good stuff here.
Yes.
Let's get to your profits. We're looking at a couple specific stocks here.
Yes.
So Taylor, why don't you kick us off with this first one?
Yes, so this first chart that you're seeing behind us is for Fidelity. It's one of the big banks that we talked about in the past. They're kind of one of the bigger names in investing that they have been, and now they're getting into fintech more and more. Like we said, they just announced that they're going to start doing commission-free trading, which is huge for them. And we saw in the past 6 months they had a $902 gain, which is pretty good over short term. And as you can see, it's just got this upward stride that we can just expect to go further with this new fintech development.
Exactly, and of course that $902 gain would have been bigger the more you put into it. So it's all relative here, but $902, an extra $902 in 6 months, you know, decent change in your pocket there.
For sure.
And then this one's a bit bigger, JP Morgan, you know, it's good to see them keeping up with the little guys. These little companies, again, just to go back to M1 and Betterment and Robinhood, are going to push these big banks to really make sure they're on top of this.
For sure.
So what do you like about JP Morgan?
So what I like about JP Morgan, besides the chart here and the $1,084 gain that we saw in the past 6 months, I like that they're doing things in addition to just investment, like apps and the new ways that you can invest. They're also getting into blockchain, which you mentioned, Bitcoin and cryptocurrency, which is really big for a big bank like this because they're a big name. They're considered kind of older money, if you will. It's really interesting to see that they're getting into the crypto side of things, which shows that it is right to be bullish on the cryptocurrency in the future because it is going to start taking over more and more as it's accepted by existing financial institutions.
That's exactly right. You know, so again, it's good to see these big players keeping up, and they will get pushed, and that means money will flood down into your pockets instead of going up the other way. So again, forget all these headlines. We say this so many times
all the time.
Everything you're reading in the news, you know, make sure you're steering clear of that, because we aim to guide you in the right direction here. So any last words on these payouts here or anything else?
I don't think so.
No?
I think that's all of it.
Well, I appreciate you joining me today, Taylor.
Yeah, of course.
We'll talk to you next time.
Thanks for watching the latest episode of WSI TV. Be sure to visit WSITV.com where you can subscribe for free with no contract and gain instant access to the secrets of self-made millionaires via the WSI TV Vault. So go ahead and claim this gift for free now at WSITV.com.